VindiGPT.com.
Welcome back, value investors. Welcome to a new video. Today we'll be speaking about Kering. Maybe the company name Kering is less known to you. Some of you probably very well know brands like Gucci, Yves Saint Laurent, Boucheron, maybe, etc. Balenciaga as well. So that's probably more for the younger people. So those brands are all today owned by a holding company called Kering, which is listed on the public stock market. And we'll be looking at what is going on at Kering and maybe wondering if Kering is a good investment or not. Right, first of all, as a disclaimer, I want to share with you in full transparency that I am a shareholder of Kering, a small one of course, but I have a couple of hundreds of shares of Kering in my portfolio, so I want to mention that. The second thing I want to mention as well, you're gonna see some, I hope, nice pictures that you're gonna like for example this picture which appears to be shot in Paris. Those pictures are done with generative AI using Midjourney, so there is no copyright infringement on that. Just wanted to mention that to you. Also as well, I mean, we are speaking here and we are looking more specifically if Kering is a good investment opportunity or not. Again, the content of this video is really educational. I'm not soliciting you to buy, to sell, or to hold the company. I already disclosed that I am a shareholder of the company. And always remember that investing into stock markets involves a certain amount of risks. Of course, I mean, me as a value investor, I invest into more solid companies, so I'm not speculating, I'm really investing and trying to estimate the intrinsic value of a company. But just wanted to mention that to you, so please be attentive always related to the type of investments that you do. Right. So the video has actually three sections. We're going to start with the history of Kering, then looking at the current performance, and then looking at the company valuation. So history, let's start with that. So Kering, actually the group Kering, you see the logo here, very nice logo I must say, has been created by François Pinault, who founded in the 60s the Établissement Pinault, in fact, which was a timber, so a wood trading company in Rennes, which is the west side of France, in fact, in Brittany. And he actually did a couple of acquisitions in the same, let's say, industry. And by 1988, actually, the company became listed on the Paris Stock Exchange. In fact, known today for most of you through the index of the CAC 40, for example. And by 1988, actually, the group actually owns at that time 180 companies and 33 factories, which was already very, very big, actually. So like in a, let's say, a period of 2.5 decades, in fact. And then by 1990, so 990, the first diversification came. So the company decided actually to move into specialized retail distribution. And this was, I'll call it the second era of what is called today Kering. At that time it was called Pinault Printemps La Redoute. So they acquired in 1989 a company called CFAO, which was a French distribution conglomerate active in Africa. They also then acquired brands. I mean, for the European people that are watching this video, or for sure for the French people, you know the French furniture store Conforama. You probably know Printemps, those department stores. They also had La Redoute, which is this famous magazine at that time. And then Fnac, which is still existing today, which is something like the equivalent of Amazon, but in store. So it's one of the most famous French bookstores, in fact, selling also multimedia and electronics. So they are a retailer. They have also an online store like Amazon, where Amazon does not have actually any, let's say, brick and mortar stores. But Fnac is very, very, very well known in France as well. And the group was renamed in 1994 PPR, so Pinault Printemps Redoute, in fact. So this was, let's say, the second era of the Kering Group. Then the third era, the third big phase, was actually the expansion and another diversification phase going into luxury. So in 1999, actually, the at that time PPR Group, they took a 42% controlling stake of Gucci. That I mean, there has been actually even a movie about the Gucci family a couple of years ago, 1-2 years ago. And also they acquired Yves Saint Laurent. So they acquired 100% of the Yves Saint Laurent, let's say, brands. So between 2000 and 2004, they acquired Boucheron, they acquired Bottega Veneta, they acquired Balenciaga, and by then also they increased the ownership to 99.4% of Gucci, in fact. And between 2011 and 2014, they continued some acquisitions. Acquisitions are still, active today, like Pomellato Group, Girard-Perregaux for example, the Swatch, did I say the Swatch lovers? The watch lovers in the room. So very well known, in fact, luxury brand on watches. So you see here a little bit the type of companies that they have acquired. What happened also during that period is that they decided between 2006 and 2013 to completely divest from the retail activity. So they sold Le Printemps, they sold Conforama, they sold CFAO, they sold Fnac, and they sold La Redoute. So today, in fact, the group, if we look at the brands, the group is actually exclusively focused on luxury. So you see here the most, I would say, known brands from the Kering Group. So Bottega Veneta, Ginori, Kering, that's, I think, jewelry that they bought a couple of years ago. SaintLaurent, which is no longer now called Yves Saint Laurent, but it's just called SaintLaurent. Boucheron as well, of course, Gucci, Alexander McQueen, which is also a very well-known brand, Balenciaga, Dodo, Brioni, Pomellato, and then also they are into the eyewear as well. And you're going to see this later on, is actually one of the only activities that currently is growing within the Kering Group. Right. Speaking about brands, I will later on also show to you how they perform in terms of profitability and growth to their main competitors. So if we look at their main competitors, but just from a brand perspective, not from a company perspective, Kering as a brand is not known to a lot of people. Let's be very honest. Within the Kering brand, so what I was showing here actually, the brand that is most known is Gucci, right? And if we compare this, and we will speak about LVMH later on, so Louis Vuitton, Moet Hennessy, so they have brands that are very well known, like Louis Vuitton itself, Chanel as well, so the brand from Coco Chanel. And then we have Hermes, so Hermes International, which is the name of the company, and the brand Hermes is actually also very well known. So you see that from the top 100 brands, and for those who follow me since a certain period, you know that I also look at, before investing into companies, about their strength of the brands. And you see here, so I'm using the Interbrand Top 100 that is being published every year. And the last Best Global Brands ranking of 2023 from Interbrand was showing that Louis Vuitton is 14th brand in the world, growing by 5%. Chanel has been growing by 6%. 22nd brand in the world. Hermes has been growing by 10%, 23rd brand in the world, and Gucci has been declining by 2%, but still 34th brand in the world. And I can tell you it's not easy to be part of the top 100 brands. Even a brand like Nvidia, for example, is not in the top 100 last year. Probably this year it's going to be appearing, but at least last year it was not even the top 100. So, and do other brands of the Kering Group, are they part of the top 100? No, the only brand that is part of the top 100 of the Kering Group is actually Gucci. In terms of stores, just to give you a sense of the footprint before we move into the performance part, they have, according to the December 31st, 2023, so I took this information from their annual report and from their website. So you see where they have stores. You see the focus is very strong on Asia Pacific. Western Europe has 367 stores, but Asia Pacific has 698 stores. We all know, I love luxury since many, many years in terms of investment, I would say category, and in terms of industry, because people are willing to pay a premium. They're pretty sticky to the brands. And indeed, the last years, it's the same for luxury automobiles. A lot actually of the growth of those groups has not come from Western Europe, has not come from the US. It came from Asia, in fact, if it is Japan, China specifically as well, but also India and those type of countries, Middle East as well, right? So of course it's normal that the footprint looks like this. But you see that it's a company that is present all over the world, right? So now looking at the performance. And why did I decide to make a video about this? I had two students who asked me to make a video about Kering and asking me, is it a good investment or not? And those students know that I do have Kering since I think it's now like 2 years in my portfolio. And what has been happening, and I'm showing you here let's say a screenshot from a tool that I use, which is called TradingView, which shows actually that compared to 3 years ago, the share price of Kering has lost 70% rough cut. It has lost 2/3 of the market valuation. So at the peak, it was like around 800 euros a share, and now it's sitting around the above 250 euros per share. So that's a tough hit for the shareholders, right? And but the question is now, as you know, I'm a serious investor. I don't look at graphs and take investment decisions just based on graphs, but I try really to reduce the amount of risk when doing investments by indeed understanding the fundamentals of the company. That's actually why also I'm teaching value investing. And let's first look at the financial performance. So I'm looking at 2022, 2023 first of all. This is an extract, and I've put you the URL below. This is an extract from the Kering website. So you see that indeed the revenues have decreased by 4%. And the profitability has rough cut decreased by, let's say, 15%. So if I look at the net income attributable to owners of the parent, so the profitability has really come down. But still, they're making profits. And the profits are still above 10%. So what I call the return on invested capital. If there is one measure that shareholders and owners of company have to look at the performance of their CEO, CFO, the management team, is really the return on invested capital. I really mean here financial measure. There are other measures like customer satisfaction, employee satisfaction that are also very, very key to determine potentially how the company will, let's say, look like in the future. So, but ROIC is still above 10%, but you're going to see later on, actually, indeed, it's coming down. It was pretty high, like 18% 3 years ago, and now it's getting closer to 10%. And people and investors are getting nervous, and the market is getting nervous about this. Nonetheless, just note here, have a look at non-luxury companies and what their ROICs are in average. And as I've been learning from Warren Buffett, when a company has an ROIC that is above 10% for many years in a row, it has very probably a moat. So it has some kind of strong competitive advantage. But it doesn't mean that you have to be blind about it. So of course, the ROIC is coming down. I'm going to show this to you later on. So, in order to understand also where the revenues are coming from, it's interesting also to see, not related just to the stores, but you see that actually 35% of the revenue is coming from Asia Pacific and 7% actually is coming from Japan. So you see that rough cut of the revenues are coming from abroad, let's say the Asia side of the world. And of course, if Asia also has issues, people will spend less on luxury. So that, of course, just that you understand where the revenues are coming from. So now let's go a little bit deeper into it. And as they call it in the luxury world, they like to use the term, they don't use the term brands, but they use the term houses or maison in French, which feels more exquisite, as some people would say, because brands feels like very, let's say, consumer basic stuff, so they call it houses or maison. And you see actually, if you took the main houses that they have, the Kering Group, you see that Gucci, the revenues on Gucci side are decreasing. Yves Saint Laurent, the revenues are decreasing. Bottega Veneta, also the revenues are decreasing. And the other houses have been decreasing by 10% as well. So they have, when you look at this, with the exception of the Kering eyewear, where the revenues have increased by a rough cut 400 million in 2023, they do have a problem. They do have a structural problem. Some of you may remember that Balenciaga has been criticized for, if I remember well, it was a campaign. But that's not an excuse, right? Gucci is decreasing, Yves Saint Laurent is decreasing a little bit, but it's still decreasing. Bottega Veneta is decreasing, Balenciaga is decreasing as well. So, of course, if I would be the company's management, I have to think what is going on and how can I pivot this situation. What is positive is that the Kering eyewear has been increasing by 400 million, so somehow compensating a little bit the decrease of the other houses of the Kering Group. Now, you know me as an investor. I'm a serious investor, so I really look at the financials. And what I'm trying to show you here, so I looked, of course, and me being an investor, I look every quarter into the results of the companies that I own in my portfolio. So here what I'm trying to make it simple for you, I'm showing you here on the one single sheet the main let's say items of the balance sheet, the cash flow statement and the income statement, and also some key ratios as well. So first things first, when we look at, and I mean, for those who follow me, you know that I always start with the balance sheet when I analyze a company, but okay, I know that some people have difficulties doing that, so I'll start with the income statement, which is actually the third financial report that I start looking at. But okay, and the analysts, I know that they look at the income statement first. And I'm not saying that I'm not looking at it, but I look at it after the balance sheet, after the cash flow statement. Right, so on the income statement, so here I've put the two main, let's say, items of the income statement, which is the revenue and the profitability. So you see, in fact, so here I'm expanding the time horizon. So you see that from 2020, the company has been steadily increasing, 13 billion revenue, 17 billion revenue, 20 billion of revenue. And then now it's like there's kind of not a floor, I would say, but they have reached some kind of top of peak. So 20.3 billion, now it's like 19.5, 18.4 on the trailing 12 months. So let's see how the trend will go. And the profitability, you see, it has been growing from 2 billion to 3 billion, 3 billion 6, 3 billion, and now trailing 12 months is coming down to 2 billion. So, I mean, and of course, people start getting nervous about this. Even though the profitability is still above 10% of the revenue, but it's no longer like 20% as it was before. So that's definitely something that people get nervous about when they invest into companies and looking at even sometimes short-term expectations and movements of the market that they try to predict. I don't try to predict the market. Then when we look at solvency, because one of the things that I learned, actually this is from Peter Lynch that I learned listening to his 1993 video at the New York Economic Circle, is that you have to look at solvency as well. So, okay, the company first of all is still very profitable, above 10%. It's coming down a little bit, so they have maybe some issues on the brands and the perception by the customers, or maybe the customers are no longer willing to pay some type of premium on that. But of course, something that you have to look, and this is something I recommend to my investment students that they always do, is they look at the solvency of the company. Is the company potentially going bankrupt very soon, yes or no? So the first thing is, of course, you have to look at debt and you have to look at interest expenses. And for that, so let's first look at the debt to equity ratio, which is one of the main ratios that I look into. And you see actually that, so I like to invest into companies that have very low debt to equity ratios, below 1.5, even below 1. Because those companies normally, except if they are in a liquidation scenario, but in a going concern situation, they tend not to go bankrupt, except if the figures were wrong, but that's then criminal activity, right? So the debt to equity ratio, what you see on the first bullet point number 1 here at the bottom of the screen, you see that it has been increasing to 1.58. So it means that just looking at that ratio that they have raised more debt. So let's look at the balance sheet. So I've taken here a couple of positions. So I've taken, and again, this is a summary. Of course, if you're thinking about investing into Kering, look at the financial reports of the company to have all details and make up your own mind. Here I'm just trying to summarize this for the sake of timing, but you see that indeed the liability, so this is what you have in the red frame number 2 on the right hand side. You see that indeed, compared to the previous year, the total amount of liabilities has increased a lot, like by 60% compared to 2020, where they had 16 billion of debt, or let's say, of total liabilities. And now it has increased by 10 billion to 25 billion. So what you see actually when you look at the numbers is you see that indeed the financial liability, so that's the finance debt of the company. So short term, that's what they have to pay back within the next 12 months. It remains pretty constant at 3 billion. But when you look at the long-term financial liabilities in the same red frame, you see that they have increased to 9 billion. So it means that the company has been raising, compared to the previous years, has been somehow raising 6 billion more of money. And this, of course, sits as a liability. Somebody has lent that money to the company. If it is a bank, if it is, if it is a corporate bond, somebody has been lending this money to the company. So, of course, what you want to know is, what did the company do with that money? And you already see it here, and I'm going to give the details later on. What did they do in terms of acquisitions? So you see that indeed in terms of goodwill and intangible assets, that on the balance sheet side of things, and also the property, plant and equipment, that has increased, in fact. So you see that they already, just from looking at the balance sheet, I'm guessing, without having to look at the news, I'm guessing specifically because I see 3 billion more in goodwill, I see 1 billion more in intangibles, and I see 2 billion more in property, plant and equipment, so net of depreciation, amortization. So that makes kind of my 6 billion actually. So I do see that it looks like that they have been expanding and acquiring more. That's what the goodwill increase of 3 billion is telling me, and also the intangibles are telling me. So that's already just 4 billion of the increase of the balance sheet. Right, so that's in terms of solvency. So okay, they have increased debt, they have more debt than they had before, but still the debt to equity ratio at 1.58 is reasonable. Right. One thing that also, when you're a serious investor, you have to look into is the total amount of debt versus a yearly income. That's a measure that not a lot of people look at. But basically what it means is that if the company would continue generating, and I'm taking here on the bullet point number 1, only the 2 billion of net income per year, what they're doing over the last 12 months. So what is the risk? So of course I could bring in the cash and cash equivalents. They have rough cut 4 billion of cash and cash equivalents, is what you see on the very first line on the balance sheet. So, and they have actually a financial debt of, let's say, 12.7 billion, right? So how many years would it take of annual income to pay off the financial debt if there would be an urgent situation for the company? So you see that actually it's 6 times. So it means that if they would earn, and that's an assumption, if they would continue to earn 2 billion per year for the next 6 years, they would be able to pay off completely their debt. Of course, that's not the intention, because when you invest into new companies, when you do acquisitions, when you buy buildings, I mean, you have a depreciation period of probably like 30 years. Some brands even have unlimited depreciation periods. But still, I mean, I believe that through this number, so that's the total debt to yearly income ratio, which is something that I look into when I analyze companies, I don't have the feeling that the company will go bankrupt. Another ratio that is much more known by serious investors is the interest coverage ratio. So typically when you look at solvency, you look at interest coverage ratio. Well, what the first, let's say, investors do, they look at debt to equity, then they look at interest coverage ratio, and I add total debt to yearly income as well. So interest coverage ratio actually gives you a sense of, on the interest expense, so what is the cost of servicing the debt every year, and you actually take that and you compare it to the net income, to make it simple. And for those who follow Aswad Damodaran, who is the Dean of Valuation, so he is a professor at New York, at the Stern Business School of the New York University. So he actually says that when the interest coverage ratio is above 8, you are in AAA. So that means that you are the highest investment grades for a company from a solvency perspective. So the interest coverage ratio of Kering, even with them raising rough cut 6 billion more in debt, is 39 times. I mean, short term, this company cannot go bankrupt. The only way the company would go bankrupt is potentially if they are making losses or they're continuing to raising debt, and then the debt becomes unsustainable, even from an interest cost or interest expense perspective. Right, so of course, me as an investor, I mean, I'm a Kering shareholder, as I said. I like to know, I mean, they have been raising the debt, so some people get nervous about this, but I wanted to know, what did they do with the debt, right? I mean, I'm kind of supposing, looking just at the balance sheet, because I saw goodwill, if you remember here, I saw goodwill and intangibles increasing, that they went on an acquisition spree. So they have acquired stuff, but I want to know what they have acquired. So of course, I mean, being a listed company, Kering indeed is sharing what they have acquired to their shareholders. So most of the debt they have been using for two strategic actions. The first one is that they bought so Kering has now also, let's say, a division called Kering Beauté, and there they have acquired the high-end luxury fragrance house called Creed. That was an all-cash transaction. Okay, so they spent rough cut 4 billion of the money that they raise in order to buy Creed. So Creed, of course, when as an investor you buy a company, or as a CEO when you buy a company, you buy the assets of the company, and of course you hope that, you pay a certain price, hoping that that price will generate some future profits as well. So this is something that was done by Kering. That's the first big transaction that happened in 2023. The second one is that they acquired 30% of Valentino. Maybe some of you know the brand Valentino. I'm not a fashion, neither victim nor expert, but I hear from time to time when you look at, if it is at the Cannes Film Festival or the Oscar ceremony, you see sometimes pictures of people who are dressing either a Dior dress, or they are dressing up with Valentino, etc., etc. So Kering has actually acquired 30% of Valentino for rough cut 1.7 billion. So you see that between those two numbers, you have let's say 5.5 billion that have been spent. And what is interesting as well from a strategic perspective on the portfolio of Kering moving forward is that with, I think, if I'm not mistaken, that Valentino was owned by, here it is. Valentino is owned, or was owned, by Mahula, which I think is a private equity company, and actually they have sold 30%, but there is already an agreement to buy 100% as an option by 2028 for Kering. So probably they're gonna be observing if Valentino indeed is delivering what is promised in terms of, let's say, profitability, growth, etc., and customer retention potentially as well, employee retention, etc. And they have the option by 2028 to buy 100% of Valentino. The price is not known, but we'll know at that time what it will be. Another thing that is important to analyze is the return to shareholders, right? So one of the things, and I will show this to you later on as well when doing the valuation, is something that I like to look at is indeed the dividend payout ratio. And the dividend payout ratio, when you look at the amount of cash dividends that is being spent and versus the net income. So if I go back here, so you see that if you look at the net income, which is the bullet point number 1, 2 million, and you just look 4 or 5 lines above the cash dividends, 1.7 billion. So you see that, and that's indeed a risk where maybe the market is getting nervous, and it's something that I teach my students as well to have a look into, is the dividend payout ratio. So today, some people invest into companies that pay out a certain amount of dividends, but they get trapped because they have seen a huge dividend yield of sometimes 10%, but the problem is that they only look at the yield and they don't look at the payout ratio. And by that, actually, they don't figure out that the dividends are not sustainable over time. And this has happened to some companies, and we'll not mention them, or I could quickly mention them here. This happened to McDonald's, I think, in the mid of the 2000s, or was it 2014, 2016, I don't remember. And Petrobras, the Brazilian oil and gas company, also had this issue where they actually had a dividend payout ratio that was not sustainable. So my recommendation is always to have a dividend payout ratio between 30 and 70%. So even if the income gets down, if you're below 70% of payout ratio, it's still sustainable for a certain period of time, not forever, of course. And here it's at 82%. That's kind of a, I will say, warning flag. So if the income continues to go down, actually they're gonna spend more cash providing the same amount of dividends that they have today versus what they're generating in profits. That would not be something that would be sustainable over time. And by then, of course, I would expect that the company, as for example, the company 3M did, that we had in the portfolio, we have sold now that stake after 2 years in our portfolio, but that at a certain time, the management reduces the amount of dividends that are being paid out to shareholders. Right. One of the things that is also interesting to analyze is looking at competition, right? And I tried here in a very, very, very straightforward way. I pulled together the figures from the financial reports of LVMH, so Louis Vuitton, Moet Hennessy, Richemont, Kering, Hermes, Prada, and Burberry. Those are like the together with Kering, those are the top 6 luxury groups or conglomerates in the world. You clearly see, if you look at the first, let's say, red frames with the red bullet point number 1, you clearly see that Louis Vuitton is by far by a couple of miles is the biggest one with, so trailing 12 months, 85 billion of revenue. Richemont is the second largest one with 20 billion of revenue. We had Richemont in the portfolio as well. I think I had it for 57 Swiss francs a share and I sold it for, I don't remember, 93, something like this. And Kering is the third one with 18 billion. And then you have Hermes International with 14. They're growing pretty fast. The market is pretty, I mean, that's now I would say the cool kid on the block in the luxury industry. I mean, it's very high valued. And then you have Prada. You already see that this is a different league. So you have like the top one, which is LVMH. And then you have like the three that are very close, Richemont, Kering, Hermes, with Hermes picking up. And you have Prada, Burberry, which are actually pretty small. I don't know what will happen to Prada, Burberry, but maybe there is somewhere an opportunity of consolidation in the future. Let's see what will happen. So in terms of revenues, you see that LVMH, Richemont, and Hermes have been increasing. A small warning signal on LVMH, where you see on the trailing 12 months has decreased a little bit. Again, disclaimer here, we do have, so it's not LVMH that we have in our portfolio, it's Christian Dior International, which is the holding above LVMH. So actually we have both companies that you can buy on the stock exchange, but we are also a LVMH shareholder on top of being Kering. So you see that I like investing into luxury. I invested into Richemont. I would love to invest into Hermes, but for the time being, it's just too high for me. So then in terms of net income, indeed, if you compare to other companies, again, same warning signal for LVMH. You see that it has come down a little bit, but Kering, indeed, that's the one where you have the most important decrease in terms of profitability. We're looking here at the net income with this red frame and bullet point number 2. You see that Hermes' profitability is crazy high in terms of growth. And of course, that's the reason why the market is actually punishing Kering, being a little bit skeptic about LVMH, very enthusiastic about Richemont, and extremely enthusiastic about Hermes. In fact, you see that the profitability is really growing. And here I will not go into the details, but you have the same figures but expressed in percentages. What I want to show you here is, and again, we have to put this into perspective. We are looking at companies that are generating in average, and that's typical for the luxury industry, they generate in average more than 10% profits on their revenues every year. I promise you, have a look at other companies. I mean, you don't have a lot of companies and you don't have a lot of industries that generate more than 10% profitability every year. I mean, you have some, look at aviation, for example. I mean, it's a very unattractive business, right? I'm not saying that there are bad companies, but it's much more risky. And I mean, you have huge costs. You cannot, I mean, of course, with the low cost model that kicked in a couple of years ago, you no longer can have people pay premium prices. So, I mean, it's much more difficult industry. But luxury is an industry that has been indeed being very profitable since many, many years. And again, just looking back at the history of Kering, I mean, Kering was in the timber business, then they went into retail, and they have sold everything, and they are now purely focused on luxury. There's probably a reason to that, which is profitability versus timber versus also retail industry. So just want to put this into perspective. Now, company evaluation. So, I mean, as you know, we are developing VinGPT, which is a value investing tool. And we are showing you here how to do evaluation with VinGPT. So first of all, I start, of course, being polite, and I'm asking Vin if it has Kering in its companies. And you see here on the right-hand side, so that's the video that I recorded with the team for the purpose of this educational video. So it says, yes, I do have it with this ticker, and it's part of the luxury goods industry. Now I'm asking actually Vinch to do a fundamental analysis, and I will stop the video just 1 second here. So of course, I mean, for those who did the other value investing training, you know what a fundamental or level 1 analysis is. So I'm looking at a couple of ratios. Let me just pause the video here. So you see, for example, I'm looking at the modes, at the price to earnings ratio, price to free cash flow, the dividend yield, dividend payout ratio. Remember, I was mentioning 82%, just do the math, 1.7 billion on 2 billion 86, that's 82%. So you see that indeed Vinch is providing that number. Capital spending, it also shows the debt to equity ratio. That's the latest one, even though now it's increasing. You have the ROIC. So you see now if you remove actually cash, so that would be unemployed capital, you see that it's really at this maximum limit, what I call being between 8 and 10%. And dividend yield is currently very high at 5.39. But of course, if the dividend payout ratio becomes unsustainable, this dividend yield will go down as well. This is what we would call a value trap. So just showing you here how Vinci is doing it. So Vinci is pulling the data, and then of course it's making an analysis of it for you. So it's providing, as we have trained the model through many years, we have been now, because I'm doing these valuations for myself and I'm using Vinci for myself, and I don't want to use any Excel files. I want to have a tool, a productivity tool that helps me analyze this. Now what I'm asking Vinci is to calculate the intrinsic value. And by the way, let me just stop here 1 second before showing you the results when I'm asking this to Vinci. So here you have, in fact, the sequence of prompts. So what you see in this video, there have been 10 prompts that I've submitted to Vinci actually. So the third one, the fourth one, we had the fourth prompt now, is calculate the intrinsic values for the company. And Vinci knows, of course, and we have trained the model how to calculate it. So it says, well, based on the August 16th data, this is the intrinsic value on the dividend discount model, on the discounted cash flow and discounted future earnings. I mean, if you do not know what that is, go to the training, The Art of Value Investing, and learn what does that mean to do an intrinsic valuation with the discounted cash flow, discounted future earnings. So here what I'm asking is also Vinci to calculate me the margin of safety, because one of the things I learned from Warren Buffett is that you should not buy a company if you don't have 25 to 30% safety margin. So that the current share price is 25 to 30% below its intrinsic value. And of course, you need to pay attention. The intrinsic value, normally, I mean, investors, they look at discounted cash flow, discounted future earnings. So you see that currently it looks like with a certain, and let me just pause here 1 second, with a certain amount of assumptions, you have a 13 to 18% margin of safety on the current share price. So it would look like that the market undervalues the share price of Kering. This is actually how you should interpret this. And again, if you do not know, you want to learn more about it, go to the Art of Value Investing training. Now, there's always one thing, and we need to be transparent about this, is calculating a discounted cash flow intrinsic value or discounted future earnings intrinsic value needs some assumptions. And the assumptions are not only based on the current earnings or the current free cash flow to the firm of the company, but it also requires some assumptions around what is the growth that we are forecasting for the next 30 years, what is the cost of capital, so what should that be, because they're going to be discounting, so I'm going to be calculating a present value of the future earnings and the future cash flows of the company. And even the assumption of 30 years is something, it's an assumption. So some people would say, yeah, I just want to do the valuation on 20 years because in 20 years time the company will have disappeared. So I'm just showing you here that you can of course prompt the model on what cost of capital and which growth assumptions have you been using, and then Vinci replies, and this we have trained the model per default with this. It uses, if you are not specifying it, it uses 7% cost of capital, 3% growth rate, and a time horizon of 30 years without terminal value. And that is what is an appropriate cost of capital for the company. So Vinci knows the industries, and Vinci knows that when I'm asking a similar prompt, that it will look in the luxury goods industry, and we're using the Aswa Damodaran database that he's kindly publishing every year. And we are, I mean, I've been sharing this with Aswa Damodaran as well. So we are actually providing the industry cost of capital. And then and you see, let me just pause here 1 second, that Vinci actually understands, because it's artificial intelligence, it understands that if I'm asking the industry cost of capital, it's because maybe I want to change the 7% discount rate and use the new cost of capital instead. And you see that here, if you see my mouse, it says if you would like to adjust intrinsic value calculation with this cost of capital, I can assist with that. I mean, that's brilliant. That's what we want from AI, right? So the next prompt is pretty straightforward. You see it here. I'm just asking, yes, please do so. So I don't have to repeat or to tell him exactly, explicitly what the instructions are. So what it does then, let me just resume here at the video. So what it does, it then recalculates actually the intrinsic values with the new growth assumptions, with the new cost of capital, not with the growth assumptions. And you see here then it would be fairly valued because we have negative figures on the margin of safety. And then what I'm doing is I'm just just assuming that there's going to be growth for the next 30 years at Kering because they bought Creed, they bought some Valentino, Kering eyewear is increasing. So I'm just saying instead of using 3%, use me 5% growth rate and keep the 9.82% cost of capital. And then recalculate the margins of safety, where it says, well, I have a margin of safety of 6 to 12%. So when I did this video, actually, it looked like the market was undervaluing by 6 to 11%. With these assumptions, the share price of Kering, or what, let's say the intrinsic value, was actually worth more than what the share price was shown on the market or listed on the market. So just here, you see what I like about Vinj, and of course we have started this project November 2023, and since May 1st it's out, is really that at the end I said to the model, okay, thanks a lot, that was very helpful. And we have trained the model to be polite and respectful and fair and ethical. So I like the last sentence, which says, you are very welcome. I'm glad I could help. If you have any more questions or need further in the future, feel free to reach out. Happy investing. Of course, the model has been built on top of ChatGPT Plus or OpenAI. And we love what they're doing. So it's really, really, really great. All right. So we are through it. Conclusion, you see that revenues have decreased across nearly all houses, with the exception of Kering eyewear. Let's be very honest, LVMH and Hermes, they perform better currently. Again, disclaimer here, I do own LVMH and Kering. I do not own Hermes for the time being. I hope that will change in the future. The RS3 remains high nonetheless. So we are somewhere still at the limit of 8 to 10%, which I like. The solvency is high. I don't think that the company will go bankrupt, but of course they need to sustain the amount of profits that they generate at, let's say, rough cut 2 billion. Otherwise, even the dividend will not remain sustainable. The debt has increased, and you have understood why. They have funded expansion, Creed, so this fragrance, high luxury fragrance brands, and Valentino, so they took this 30% stake from the private equity owner of Valentino. So as already said, dividend payout ratio, we need to observe this, but it's getting really close to being sustainable, so pay attention to that. And the intrinsic value, of course, it depends on the growth assumption. So that's why also my training is called the Art of Value Investing training, because the art means that it requires human judgment. So you need to define what the right cost of capital for you is, what are the right growth assumptions in the future, and the duration, 30 years. And remember, we don't use terminal value because we believe that biases the models. So also as a disclaimer, I already mentioned that we do own Kering, and we do own it currently. So we continue to cost average. So honestly, we believe for us, and again, I'm not soliciting you now to go and buy Kering, but for us, we will continue buying into Kering. And today, so we started at, 500 and something euro per share, and we continue to buy. And for the time being, we have an average share price of 374 euros per share. So let's see what the future will bring. And again, it's not a solicitation for you to buy or to sell or to hold, but again, this is for educational purposes. And I hope that this was useful, and looking forward to talking to you in the next video, or even potentially in the next webinar. By the way, there is a next webinar coming up September 14th. So feel free to share your ideas for the webinar or topics that you would like me to address with the GPT team. With that, thanks for your attention. Talk to you later.